Welcome back to Fast Money Live at the NASDAQ market site. Time now for our Fast Money portfolio. This is a new feature where long-term investing meets the volatility of today's world. So up today is Mike Kirby. He's Chairman and Director of Research at Green Street Advisors. His firm focuses on commercial real estate and real estate investment trusts, or REITs. Good to see you. Give us your outlook here, your long-term play when it comes to commercial real estate and REITs, Mike.
Well, thank you. The long-term outlook is still very good, and I think the basic point is that most people probably have too little exposure to commercial real estate as an asset class. Until 20 years ago, it was very difficult for the average investor, be they institutions or retail investors, to access this asset class. And yet it's one of the biggest asset classes out there. I mean,
yeah, before REITs you had to buy a building, right? Now
exactly.
You can just buy the REITs.
Exactly, and that's just not really possible for the average investor, and even for institutions that can, it's still a better vehicle to do that. And so it's an asset class that most, if you buy a broad-based stock index fund, you barely own any commercial real estate. They're only 1 or 2% of the S&P 500. So you have to go out of your way to invest in REITs, and it's probably a good idea because otherwise you're underinvested in this major asset class.
Brian?
Yeah, my question is about the apartment REIT area. I mean, we've seen rents on houses doing fairly well. A lot of people are starting to have private equity funds that will buy single-family homes, and then we're also seeing an awful lot of apartment buildings being built. Is this the end of the apartment building cycle and more in the housing cycle?
You know, some of that is happening. You're absolutely right. We are still pretty bullish, though, at Green Street on what lies ahead for the next couple of years in terms of apartment fundamentals. We see the home ownership rate continuing to decline for a couple more years or so. And today it's at 66%. I think it'll be 64% by the time it hits bottom. You still have a lot of people living in houses they can't afford. And so the trend for the next couple of years is for great rental demand. The bottom you're seeing hit in housing is taking place very slowly. I think eventually it will turn. But in the meantime, the apartment landlords really can dictate rents, and that's continuing this year. We expect rental growth this year to be excellent.
And yet, Mike, when we show people what you like, you got a mall REIT, Taubman Centers, Equity Lifestyles, it's an RV REIT, and then Extra Space Storage is a storage REIT. Why are those better than, say, apartments after you've just given us that long speech about why they're so good?
Well, I think REIT investors are pretty well aware of what I just said. I mean, you're going to see apartment NOIs, cash flow grow by, call it 7% this year, and that'll taper down to 3%. Still good a few years out. But those other niches are niches that we think are positioned for the very well for the long run. So malls, by way of example, are doing great. I mean, at the high end, and that's what Taubman owns. Taubman owns the finest malls in the country. And the rich get richer theme is playing out in mall space, where the good malls get better and the weak malls get worse. Taubman's a strong play on that. And the other two niches are two niches that have done exceedingly well. They're really not very well appreciated, but they're wonderful little businesses. That is self-storage and manufactured housing. They're really neat little businesses.
Mike, for the people playing the home game, if they don't want to drill down specific ETF, like a Vanguard, the VNQ, is that something you follow, or it's something you would talk about here? Yeah,
I think it's certainly a reasonable way for the average individual to play the game. I mean, the REIT space there's over 100 REITs in the U.S., and it's very daunting for the average retail investor to play in that space. So I'd recommend either going with an ETF, or it's also a space where active managers do a good job, and that's because you can really get a good estimate of the intrinsic value of a REIT if you're willing to go out and do the work. And so whether it's through an active manager, through a mutual fund, or through an index approach through an ETF, I think both are effective.
Mike, good to see you. Thanks for joining us.
Thank you.